What's up, guys? Welcome back to Taxes Made Simple. I'm your host, Karlton Dennis, and in today's video, I want to talk about a topic that is so important to me: offsetting W-2 and active income. If you're a W-2 taxpayer, that means that you've chosen a career to work for another professional, and you probably love your job. And I don't want you to think about starting a business just to reduce your tax bill, but I do want you to consider some of these strategies that can help position you to be a savvier taxpayer. What I've done is I put together 5 top strategies that you can implement that will help you reduce your W-2 income taxes and your active income. Without further ado, let's dive in. All right, guys, strategy number 1 is qualifying as a real estate professional. Now, you may have never heard of this concept before, real estate professional, but allow me to explain it. A real estate professional is someone who can show the IRS, not a test, not a school, not Harvard, not Yale, but the IRS, that you can spend 750 hours in a real property trader business. Now, what that means to you is buying an investment property and choosing to manage that property for 750 hours out of the year. But the downside to being able to do this strategy is that many W-2 taxpayers are unaware that this is actually a 2-part test. Simply qualifying and spending 750 hours is just test number 1. But test number 2 is showing the IRS that you can spend more than half of your time in your real property trader business than any other thing. What that means for you is if you're working a W-2 job 40 hours a week, you would have to show the IRS that you're spending 41 hours in the week managing your investment property. And that's just really hard for the average W-2 taxpayer to do. One of the benefits to having another spouse who files tax returns with you jointly is by being able to qualify a spouse who's maybe not working or not carrying on an active job or duty, qualifying your spouse to be the real estate professional on the return. What this will do for you is it will unlock real estate losses from depreciation. And once you unlock real estate losses from depreciation, you can boost those real estate losses by performing a cost segregation study. What this will do is it'll give you anywhere between 20 to 30% of your property's value as a year 1 tax write-off. Could you imagine earning $250,000 or $300,000 W-2 and receiving a $200,000 or $300,000 tax write-off? Well, this is the power of being able to use the real estate professional strategy correctly. But what disqualifies many W-2 taxpayers from qualifying as real estate professionals is the time commitment. Spending 750 hours is not easy in the average year, especially when you find out about this tax strategy late in the year. And being able to show the IRS that you're spending more time in real estate than any other thing. This is part of the reason why I would encourage you to move to strategy number 2. Strategy number 2 is qualifying for the short-term rental loophole. The short-term rental loophole is extremely interesting and has become very popular in the last coming months. The reason why is because many taxpayers are finding out that the IRS has written specific laws around short-term rentals. And if your average period of customer use inside of your short-term rental, such as an Airbnb or VRBO, is 7 days or less per customer in the entire year, you're able to benefit from real estate losses without qualifying as a real estate professional. For the many W-2 taxpayers who I work with, they are so ecstatic when they find out about this tax law because they don't have to spend 750 hours or spend more time managing their investment properties than their working job. What is required is for that investor to spend 100 hours and more time than any other person managing this real property trader business or this short-term rental. In this situation, you too can unlock your real estate losses to offset your W-2 or 1099 income. By performing a cost segregation study, very similar to the real estate professional, you will be able to boost your losses on the tax return to offset your W-2 and your 1099 income. This year in 2023, I had over 270 of my clients purchase short-term rentals to offset their W-2 taxes, and this is a tax law that I do anticipate remaining in the IRS tax code. Strategy number 3 is contributing to your retirement accounts. Now, many people are fully aware that the IRS will allow for you to max out your 401k, and for 2023, that amount was $22,500. Just maxing out your 401k can dramatically reduce your overall tax bill. I mean, putting in $22,500 at a 32% tax rate is saving you upwards to $7,000 in income taxes. This is money that gets to grow in your retirement account, and when you decide to take this money out later on in life, when you're 59 and a half, you will then pay the tax consequences at that point in time. Part of the reason why many people max out their 401ks is not only to provide supplemental income in retirement, but to reduce their tax bill every single year on their ordinary income. And if you're a W-2 taxpayer, it might come with some benefits. You might have an employer that chooses to give you a match compensation around your 401k plan. This will allow for you to be able to receive some additional benefits simply by putting money into your retirement account and allowing for your employer to match you a certain percentage of that money that you're placing inside of your account. If you're looking to maximize your retirement accounts, another benefit is the traditional IRA. The traditional IRA will allow for you to put away $6,000 into another retirement account that's an individual retirement account that you have control over. Every single year, I use the traditional IRA in combination with my Roth IRA to make additional contributions to my retirement accounts so I can have money grow tax-free. For many taxpayers who are making too much money to contribute directly to a Roth IRA, you can choose to contribute to a traditional IRA and do a backdoor by converting those traditional IRA dollars into Roth IRA dollars and paying the taxes in the current year. This way, the money inside of your Roth can grow tax advantage, helping you plan for a tax-free future. Strategy number 4 is investing in oil and gas. You see, as a W-2 taxpayer, you can make investments that can turn around and create tax deductions for you. Investing into oil and gas can provide you with losses on the tax return that are actually categorized as active losses. By having active losses on the return, you can offset your active W-2 or even your active 1099 income, reducing your overall tax bill. But just keep in mind that investing in oil and gas has its own legal risks that are involved. So be sure to speak with your tax professional before you decide to make the decision to invest some of your working dollars into oil and gas. And strategy number 5, charitable deductions. For those of you who itemize your deductions, which means that your items that you're deducting on your return exceed the standard deduction amounts for the year, you are able to claim charitable deductions as a part of your itemized deductions. What this means to you is if you decide to be philanthropic this year, these philanthropic donations that you're giving to other qualified 501c3s or even making a donation to your own private family foundation can result in you saving a significant amount of money on taxes. Many taxpayers who I work with who are high net worth individuals, especially high net worth W-2, they will look at setting up their own private family foundations and making a contribution. The IRS will allow for you to roll over 30% of your adjusted gross income into your own private family foundation, and only 5% of the charitable assets inside of your foundation have to be donated to another qualified 501c3 of your choice by the time you file the foundation's tax returns. Part of the reason why I love foundations is because it's another wealth building tool. It allows for you to control money, it allows for you to hire your children and be philanthropic in the ways that you wish to be philanthropic, while all giving you control of your philanthropy dollars. In my eyes, it's important for me to be able to control my finances and reduce my taxes at the same time. And one of the ways in which we can control our finances is by choosing to be philanthropic ourselves, as opposed to just giving the tax dollars away to the government and letting the government decide what they want to do with those dollars. If you're somebody that wants to build wealth strategically, then you'll be looking into the private family foundation as a part of your wealth building strategy. So what we've done is we've discussed 5 strategies that can help you offset your active and your W-2 income this year before 2023 is over. But if you are not able to implement the real estate professional status or the short-term rental rule, keep in mind that these strategies will exist in 2024. So if you decide to go and buy a short-term rental in 2024, you can manage that property for 100 hours and make sure that your customers are staying in that property 7 days or less in order to benefit from the cost segregation study and create a loss on the tax returns. Now, what if you're married and your wife is about to give birth? I work with a lot of parents, and many of these mothers who are raising their children let me know, Karlton, it's going to be some time before I go back to my job. Well, one of the benefits for them not going back to their job so quickly is being able to position the wife to be the real estate professional on the tax return. This will allow for her to spend the time that she needs raising the child, but also managing over the real estate portfolio for the eyes of the IRS. If you need any help in leveraging real estate related strategies, you can click on the link below to schedule a consultation with my real estate tax team. What we'll do is we'll go over the opportunities that exist for you to offset your W-2 or your 1099 income before the end of the year, or help you plan on buying your own investment properties for next year so you can utilize the cost segregation strategy to create losses on the tax return. That's it for today's video, guys. Thank you so much for watching, and I hope that you subscribe. I'll see you on the next one.